Thanks everyone for tuning into Let's Talk Money. Right after the Union Budget, our focus is simple. What should your savings and investment strategy be this year, keeping in mind some of the key announcements of the Union Budget 2016? Now, the most positively received announcement was the government's intention to adhere to the fiscal deficit target of 3.5% in 2016-17. Almost everyone is speaking of a rate cut now. We are asking the experts today, how will this affect stocks and the debt market? And should you be looking at certain kind of investments more than others? The other second big headline, the huge controversial announcement of taxing 60% of employees' provident fund corpus at withdrawal was really actually meant to nudge people towards looking at another long-term pension product, the National Pension System or NPS, where now with this Union Budget, 40% withdrawal on maturity has been made tax-free. Today we'll decode NPS for you and get the panel to tell us whether NPS makes sense for building a retirement kitty for you. My guest today, Navneet Munot, CIO, SBI Mutual Fund. Also with me here in the Delhi studio, Krishan Malhotra, National Practice Head Tax, Shardul Amarchand Mangaldas & Co. and Amit Kukreja, Founder Wealth Being Advisors. Now, let's begin with the fiscal deficit target. Navneet, my first question to you is, I think the whole cheer in the stock markets and the bond markets, both markets reacted extremely positively to this announcement that we will meet 3.9% fiscal deficit target for this year and next year 3.5%. Decode this for us in terms of what is going to happen now to my mutual fund portfolio. Where should I be putting money? If my SIPs continue and I have some bulk, how would you distribute it for me?
So to make good returns on asset classes like equity and bonds over a longer period, one of the most important things is to have a stable macroeconomic environment in the country. And for that, the important things are a fiscal prudence and a good monetary policy framework. In last 2.5 years, we have seen that the government is very committed to create the foundation for a sustained growth, a kind of nice era, non-inflationary continued expansion. It also reduces our vulnerability on the global economy and global markets because the domestic savings improve if you have a stable macro environment. And I think in this very challenging global environment, in the very distressed rural area, the stressed corporate balance sheet, banks balance sheet, there's a lot of clamor for government to spend its way out, to promote to prop up the economy by spending more, but full credit to the government for adhering to the fiscal deficit target. I think the fiscal prudence, the fiscal consolidation will go a very long way in creating a structural foundation for a sustained growth, which augurs well for both the equity market and the bond market. Along with all the other measures in terms of improving the ease of doing business, the simplification of tax laws, redressal mechanism, more spending on the rural area, particularly on the rural infrastructure side to create more jobs. I think that all will do well for the corporate profitability going forward. Taking some stress out of the banking sectors by some of the measures that have been announced by the RBI and the government will go a long way in removing the concern. So I think both augur well, and as you rightly mentioned, there is a possibility of an interest rate cut now because of the fiscal prudence. So I think it's good for both the markets.
Both the markets, so he's not taking a call. But tell me,
Sure.
Is this a time really to look more at long-term debt funds, mutual funds, Amit?
So, yes and no, right? So, interest rates are going to go down. So, obviously, long-term debt funds should not be our choice. We should stick to short and medium-term funds. So, if we apply the basics of financial planning, any money that you need in the next 3 to 5 years, you can park it in short and medium-term debt funds. Any money that you need after 5 years can be parked in equity funds. Equity, given the lower rates, in the coming times, is likely to get into a better profitability, better returns on your equity. So, equity definitely holds a very good, footing. Debt, you need to protect your money.
If I have some lump sum money and I would like to take it out at the end of 3 years, would your choice be medium-term debt funds?
That's correct. I would stick to short and medium-term debt funds.
And short is what? The period is?
Anywhere between 12 months to 18 months.
12 months to 18 months. All right. Now, what's the outlook on equity mutual funds? Navneet, I'm going to come back to you now. last 1.5 years has been extremely disappointing. Everyone's sitting on a 10%, 7% to 10% to 15%, depending on the fund that they have been in. Going forward, what should the strategy be for investors who've been with equity funds? I mean, is SIP still the route to continue with, or do you think this is the time that there's so much positivity around the economy, you could bump up your investments in equity funds?
So those who have the SIP should surely continue. Those who don't have the exposure in equities should take advantage of the recent volatility and the depressed market environment and increase the exposure to equities. I would argue in favor of a lump sum investment if your allocation to equities is less. And I think those who have the money coming in next few months should at least start now and can gradually increase the exposure to equities. But at these levels, as you said, that in last 1 year markets have been down almost like 15% point to point. I think over the next 3 or 5 years, equities can deliver decent double-digit returns, and I think it's a time to increase your allocation to equities.
Amit, would you agree that you be brave, increase your allocation to equity, or do you think this is just a short-term exuberance? Global headwinds are still there. At the ground level, corporate profitability, I mean, with all that rural spending effect to actually happen, it's going to take a while for corporate profitability to increase. So are we betting on 1 year?
I'll still be cautious. So for me, SIP and STP is the preferred route any day. Second, if I need the money,
so don't bump up equities right now.
Don't do lump sum purchases. You can bump up your SIP amount, but don't do lump sum purchases.
So lump sum, if you have short-term debt fund,
move it into debt fund, and then do a periodic migration from debt to equity within the same fund house. So do STPs. Okay. Second, if you need the money between 3 and 5 years, keep the money in low risk debt funds. Don't put the money into equity funds, because we saw the equity markets doing well, and then we suddenly saw a lot of volatility in last 12 months.
So you're saying only if you have a period of more than 5 years, then you do a lump sum equity, otherwise stick to SIPs in equity and look at debt. All right, I'm going to come to you because there are other things, takeaways from the budget. Now, some of the provisions which were of course to tax the rich, people earning more than ₹1 crore will now have to pay an additional 3% surcharge on income tax. This means that the tax rate for the rich goes up from 12% to 15%. The second one, for those earning an annual dividend income of 10 lakh or more, will be required to pay an additional tax of 10%. And finally, buying a luxury car costing upwards of 10 lakh rupees or purchasing goods and services in cash exceeding 2 lakh will now attract a TDS of 1%. So, Krishan, just sum up this for you. It seems, you know, this whole government's intention to tax the rich is very noble, but then you only had 8, the numbers were very small of the people who actually declared tax over a crore.
You're absolute. Just to add, just to taking on the equity first, I would like to say that there was a big apprehension that the long-term capital gain period from 1 year, as it was expected, may be extended to 3 years.
That hasn't happened.
Which hasn't happened. So any investment which you would like to make, it's already there in the mind. And just to reaffirm that if you would see the earlier DTC, which was direct tax code, where there was a very clear provision to say that there would not be any short and long. If you earn, you just pay the taxes. That was initially DTC plan. So you cannot rule out while making an investment, you have to keep it in mind that you may not see the benefit of long-term capital gain by the time your investment would be maturing after 3 to 5 years. So it is already there in the mind of the government. I thought just to be little cautious in terms of you may have to pay tax on the shares over a period of time, the way we have seen the rumor before, and I think it is already going on in the mind of the government.
Now don't scare us and worry us about that bit. Right, this year it has not happened.
It has not happened.
Fair enough.
So in terms of, you are right, your analysis is absolutely right. They wanted to tax rich people, but as far as the dividend is concerned, yes, those who are earning more than 10 lakhs, they would have to pay over and above 20%.
Is it double taxation? Everyone's talking about it and saying this is unfair. Is it unfair?
It is unfair because there was also a news that maybe they will remove the dividend distribution tax. The one way, because someone whose slab is 2 lakhs, 2.5 lakhs to 10 lakhs and someone who's earning more than 1 crore, everyone was paying a dividend distribution tax through a company at the rate of 20%. Right. So there was a lack of equity. So therefore, in order to bring this gap, one way was that they would have removed the dividend distribution tax, which
Which
was
they
not done.
haven't.
So in order to tax now those who are having a high slab, I think they thought it just let's make it, if you are earning more than 10 lakhs, so that you pay over and above 20%.
So there's no unfairness in it. I think, when they're just, I've heard the number is 800 people who actually.
I don't know the numbers, but they are not
8,000,
very
I don't
big.
know. I mean, the numbers are extremely small of people who really declared incomes of more than 1 crore, Amit. Navneet, what's your opinion on the dividend tax? I mean, I think there has been quite a bit of unhappiness on that front. But mutual funds dividends are still not taxed.
So purely on a principle basis, philosophically, I mean, it's a triple taxation. Where corporate pays full tax, then on top of that, when you declare dividend, you pay the dividend distribution tax, and then when you receive the dividend, again you pay tax. So it's, as you said, it's not double, it's almost triple. So on a principle basis, but I think the tax revenues had to be increased somewhere, and I'm sure government would have thought about that where else the tax revenues can be increased, and they found that this is probably the impacting the least number of people and collect huge amount of money.
We'll be back in a moment to take a look at the largely ignored national pension system. That's, you got a tax benefit on it this time. 40% of the corpus that you withdraw out of NPS will be tax-free. Does it make sense for you to also look at NPS as a retirement saving investment? We'll be back.